Thank you very much, all of you, for coming along. It's a particularly interesting time for us to be discussing the state of the US economy. There's a lot going on in the macroeconomy. There's a lot going on, obviously, in the global economy. A lot of risks to the outlook. We're at an interesting time as well in terms of monetary policy, both in the US and around the world. So it's a great pleasure for me to be able to have this opportunity to lead a discussion with really two of the finest minds and most experienced minds in the policy-making field and in the field of economics. I'll very briefly introduce them and then get straight into the discussion. You know, immediately to my left is Donald Kohn, who is now the Robert Roosa Chair in International Economics and Senior Fellow in Economics at the Brookings Institution. But Don was the Vice Chair of the Board of Governors of the Federal Reserve Board for a critical time in about 10 years ago, stepped down in 2010. Before that, he was on the board of the Governors of the Federal Reserve System for a relatively long period, and before that was served as the Chief of Monetary Policy at the Fed for more than for about 15 years. So he has an extraordinary wealth of monetary policy going back to the 1987 crisis, at least, through the various crises of the 1990s and the 2000s, and of course culminating in the financial crisis of 2007, 2008. And I'll be very interested to get his perspective on that experience and how it relates as well to today, as well as what's going on more broadly in the economy today. And to his left, of course, you know Jack Lew, who is now the visiting professor of international public affairs at Columbia University and a partner at Lindsay, Goldberg, but was Treasury Secretary in the second Obama term between 2013 and 2017. And before that was White House Chief of Staff and Director of Office of Management and Budget. And unlike the practice of the current administration, you didn't do those jobs at the same time. So Jack, we're very lucky to have Jack here too. Jack served, as I say, in those critical roles throughout the Obama administration, in particular as Secretary of the Treasury. And you've probably all got banknotes with his, with Federal Reserve banknotes with his name on it. So you've not got the man himself. Maybe you'll even sign one or two of them before you know. I think you're not allowed to do that. Anyway, but once again, thank you very much indeed to my guests for being here. Thanks to the Japan Society, and thank you all of you for being here. So I'll get right into it, and I'll start, if I may, with you, both of you. The outlook for the US economy. The US economy has now been in a continuous expansion for very nearly 10 years. This current expansion will be 10 years old in July. The expansion that began after the Great Recession. Later this year, the end of next year, early next year, will become the longest expansion since records have been kept. So I'll start with both of you, if I may. I'll start with you first, Don. What are the prospects as this expansion gets very long in the tooth? Does it look like it can continue into its old age, or are there signs that it's actually maybe succumbing to something fairly soon?
So I think the prospects are good, Jerry, that it will make it to its record length, the 11-year length that you were talking about. I think we're seeing some good growth, certainly 3% last year, and most people are looking at in the 2 to 3 range this year. I think when you think about, and there are downside risks, which I assume we'll get into later, but I think when you're trying to predict whether there's going to be a recession or not, you kind of look for imbalances, things that are a little top-heavy, bottom-heavy, things that might cause businesses and consumers to pull back on what they're doing. And I just don't see those. I don't see inventory overhangs. I think people may be a little more cautious, but that's fine. The economy might be slowing down. In my view, that's fine too, because I think it's been growing faster than its potential. But I don't see the kinds of things that, to me, suggest that there's a recession coming anytime soon.
Jack, do you share that generally optimistic view?
I do, and I must say, having had a hand in the first 7.5 years of managing it, I'm rooting for it to hit a record. It would be a good thing for us to continue to grow. I actually think my optimism would be greater if we didn't see policy working in the wrong direction in so many regards. I actually think if you had a policy-neutral environment, one could be pretty confident that the downside risks are not right on the horizon. I think even with the risks that trade tensions and a confusing fiscal policy, a very loose fiscal policy at a time of extended growth, even with those kinds of distractions, it's hard to see how we don't get to July. I do think that it's important to kind of keep an eye on the risks out there. We've all watched the yield curves as they've come close to inverting. We've seen central bank governors and most recently the IMF and the World Economic Outlook start to take down both global and U.S. projections. With that said, I don't see that turning on a dime, and the kinds of signs that Don is more expert at looking for than I am are not there right now. What we can't know is whether there's going to be some dramatic event. And a year ago, I was more worried about the dramatic event than I am today, because I think the world has kind of gotten used to an extraordinary degree of day-to-day drama, which is, I guess, good until it's not. At the point when one of the drama-causing events goes the wrong way, I worry about an oversized reaction. And no one knows when that's going to be.
As well as its longevity, a hallmark of this expansion, I think it's fair to say, Don, has been its relatively weak rate of overall GDP growth. For most of the expansion, GDP growth in the last 10 years has averaged just about 2%. Historically, especially coming off a very deep recession, which we had in 2007 to 2009, that has been described as a relatively weak, relatively poor performance. Now we had an acceleration in 2018, as you pointed out, to maybe 3% growth. The early data from first quarter of 2019 and to some extent the second quarter of 2019 suggests that that isn't going to be sustainable. What's going on? Can you give us a picture of why growth has been relatively weak throughout this expansion, and whether or not some of the grander claims from the Trump administration that America is in fact being made great again and that we're seeing now maybe 3% growth or maybe even faster growth, that this is now going to be the new norm?
So I think early on in the expansion, we were being held back by the effects of the global financial crisis. So we had a complete meltdown in credit markets. Credit was very hard to get. So it would constrain both businesses and households as they were spending. The housing market, which is often a part of that sharp rebound that you referenced, Jerry, was really broken, and there had been a marked overbuilding of houses and a huge inventory overhang that we didn't need again. I think I was surprised. I expected a slow recovery. I wasn't surprised by that, but I was surprised that it didn't pick up steam later on as the credit became more available. And I think there are a couple of underlying trends that are holding us back. One is demographics, familiar theme at the Japan Society, I suspect. So the baby boomers aging, retiring, labor force participation going down. I think there was accentuating that decline was a sharp drop-off even in prime age participation by males. And some of that was due to the opioid crisis, some of that was due to the hangover from the crisis and people dropping out of the labor force and only slow. So a really encouraging thing that's happened recently is that labor force participation by prime age males and females has begun to pick up a little bit. And so this tight labor market is drawing people back in. But I still think the underlying trend, the demographic trend, suggests that that the labor force, increases in labor force to contribute to growth are going to be slower now than they were certainly when the baby boomers were in the labor market. And the second long-term trend that's been troubling is productivity. And this has been true all over the world, really. It's not just in the US, but we had a wonderful surge in productivity in the late 90s that Alan Greenspan famously spotted and played policy to take advantage of it for the American people. That continued to a certain extent in the first half of the 2000s, but around 2005 or 6, even before the crisis, productivity growth slowed down, and I think it's fair to say no one's sure why. So,
what's your hunch? I mean, to be very crude about it, there's a sort of a supply side explanation, explanation, and a demand side, the supply side explanation is loss of dynamism in the economy. The economy's, there isn't much innovation despite the sort of tech revolution. The paradox is we're not seeing as much innovation. On the demand side, there are people who argue that we're going through secular stagnation, and that is suppressing overall demand, which is having its own effect on investment incentives and that kind of stuff. What's your sense of what the explanation for this slowdown in productivity is?
So I think it's mostly supply side. Even though we carry little computers around in our pocket and you think that technology has changed very rapidly, it's not really showing up in the productivity of businesses as much as it was in the dot-com years of the 1990s. And you're right, Jerry, the dynamism of the economy in other respects. So people aren't changing jobs the way they were changing 10, 20, 30 years ago. Maybe this is partly left over from the global financial crisis. Once you go through the highest unemployment rate in 30, 40 years, you're a little bit reluctant to give up your job and look for another job. So I think there are a bunch of reasons on that supply side of the economy why things have slowed down. It has been encouraging. In 2018, there was a bit of a pickup in productivity growth. So got to 1.5, 1 3/4, I think, for the year 2018, non-farm business productivity. That was a pickup from the 1.3 that had existed through the rest of the recovery. So maybe we're seeing some pickup here. That would be great, but I think it's too early to make that call. I'd say one of the contributing factors is capital spending. So capital spending has been weak. Businesses don't see enough rationale to greatly expand their production and put in new machines. Maybe it's that technology we were talking about hasn't been changing that rapidly. So capital spending through most of the expansion after the early years has been pretty weak. It picked up a little bit last year, and in the first half of this year, maybe resulting from the tax cuts, but it looks like it's slowed down in the latter part of the year and in the early part of this year. So businesses haven't been spending for capital. That in turn contributes to a lack of dynamism and productivity. So I think right now it's a supply side problem.
Okay.
Jerry, I think the two components of demographics and productivity have to be the explanation, but unpacking how it explains it is a challenge, I think. On the demographics, I think one of the things that's important to remember is it's not just U.S. and Japan where demographics are a factor. Even in China, demographics are a factor. When you look at China's potential GDP over the next 10 years, they're paying the price now of the one-child policy. So it's one of the two largest economies of the world, has been driving a lot of global demand. That's going to tamp down even if they do a lot of things right. On the productivity and investment side, we were struck as we watched in the early years of the recovery. The housing delay we expected, you could just see the inventory of houses would take a while to draw down. It was a little bit more surprising how slow the return to investment was. Part of the explanation, I believe, is that the overhang of excess capacity was so tremendous after the Great Recession that it took a long time before there was a need for substantial new capital investment. And then when there was a need for capital investment, it was more marginal upgrading than it was wholesale replacement. The other thing that was striking was you saw the manufacturing output numbers growing pretty nicely, but manufacturing employment was just inching up. That has to do with technology. It has to do with the replacement of capital for labor. I have to say, as a non-economist, I'm puzzled at the productivity measure. I've listened to debates about it, and I know there is an argument that GDP calculations may be missing something now. I'm not going to get into the equations of national income accounting because that would not be the highest and best use of my contribution. But I will say that in the 1990s, we didn't see the productivity right away. It took a while before it became clear. And I don't know if we actually know what the productivity for the next 10 years is with the same accuracy that we would have in a period when you didn't have so much technological change.
Let me ask you, Jack, specifically on the question of policy. You leave office with the Obama administration in January 2017. Trump administration immediately comes in with a Republican Congress, managed to get a big tax cut passed, focused heavily on corporate tax cuts, although a sizable personal income tax rate cut, income tax cut too. Part of the argument is, and I can remember listening to Gary Kohn and others articulating this very powerfully, that corporate taxes, first of all, had to be brought in alignment with global tax rates, because that was obviously creating all kinds of distortions and inequities in the system, but also that it was going to energize companies to invest more, that they would invest more, they bring investment back to the United States, but that they would use this significantly reduced tax rate to invest more, and that would have its benefits in terms of productivity. Don has mentioned that we did see some productivity improvements in 2018. I don't think he would go so far as to say they were a direct result of the tax cuts. But what do you say to that argument that it was necessary to make those tax cuts, re-energize the corporate sector, sort of level the global playing field, and that itself may be producing some dividends in terms of increased investment?
There wasn't actually a disagreement that we needed to reform the corporate tax code. We actually got pretty far down the road working with then Ways and Means Committee Chairman Paul Ryan and then Speaker Paul Ryan on trying to come up with a bipartisan approach. The goal at the time was, from the administration perspective, to get to 28%. I would say from the congressional Republican perspective, to get to 25%. Nobody ever mentioned a rate lower than 25%. No CEO, no committee chairman, no leader. There was a reduction in the corporate tax rate that was beyond what anyone said was needed. And it was kind of a bidding war to show that you could get close to a campaign promise to get to 15%, which was not based in any economic necessity. So I think the size of the corporate tax cut was just overstated in terms of what was needed. Because of that, the tax bill that passed left aside what was one of the constraints of the debate when I was at Treasury, which was that it should be paid for by closing loopholes. We could have gotten to 28% closing loopholes. We couldn't get to 25%. So the kind of bid ask was, should you pay for the last 3%? In retrospect, it would have been cheaper to pay for the last 3% and not have the enormous revenue loss that went with the expansion. I would say that doing it in a way that wasn't paid for and adding a couple of $1 trillion to the debt during a period of growth is an economic mistake, and it's going to have a number of very bad effects. First of all, it's going to put a squeeze on the ability of government to invest in many of the core things that government can do to drive productivity, research and development, the training of the next generation of scientists who are necessary for the entrepreneurs to make the breakthroughs. It's going to make it difficult, if we hit a bump in the road, for the government to respond in an effective way, because the fiscal cupboard is bare, and the attempt to reload the monetary cupboard has been stopped midway because of concerns of a slowing global economy. So we don't have a great toolkit if we hit a recession. I don't think that's good for long-term growth. So I think it was overdone. I think it should have been paid for, and I don't think we've seen the investment that was predicted to come from it, but I'm not entirely surprised by that. The amount of cash that businesses had on hand gave them the ability to do all the investment they needed and wanted to do before they got the tax cut. So it was not a lack of access to capital.
Just to be clear, Don, briefly, do you generally agree with that? Do you think the tax cuts benefits were very much a short-term fiscal impulse to the economy rather than do any long-term structural changes in corporate incentives?
Yes, primarily. So there was a fiscal impulse that helped to produce the 3% growth last year, breaking out of the 2%. So at Brookings, we commissioned a paper by Jason Furman and Bob, I've lost the last name, but conservative and a liberal economist, and they concluded that the tax cuts themselves were maybe worth a tenth or two a year on potential growth. And mostly that was from the ability to write off your capital spending, the expensing of capital.
And that expires.
But to be clear, that expires. But to be clear, you don't see any, despite what you were just saying, and it's early days, and you're both agreeing that it's early days in terms of the productivity numbers, which could be being affected by all kinds of things. You don't have any, there's no real reason, to put it bluntly, to support the president's rhetoric yet that we are now on a significantly elevated growth path from where we were 2 years ago.
No, I don't see the evidence for that, and partly the evidence is in the labor market data. So the the demographics suggest that a sustainable rate of growth of increase in jobs is about 100,000 a month. And we're getting, even with the ups and downs the last few months, about 180.
Right.
So I see the economy as growing at least a little bit past its potential.
Right.
I don't see the potential may have been increased a little, but not much. And I think the evidence, we don't have evidence.
And I would just add that when we were running economic policy, Jason Furman at that time was chairman of the Council of Economic Advisors, and he cautioned all of us that the long-term growth in jobs was sustainably 100,000, not 200,000.
Right,
Yeah.
and we've seen that. So, Don, you mentioned at the beginning that this stage of an expansion in the past, we might be seeing some imbalances that would be flashing warning signals, sort of flashing yellow lights about the sustainability of the expansion, but this time we're not really seeing them, whether it's in labour market, housing, some asset markets even to some extent. One area where I think some people are concerned, though, and I wonder what your views are, is debt. We have seen a very significant increase in debt. Overall debt levels in the global economy now, both sovereign and private debt, are back above where they were at the start of the financial crisis in 2006, 2007. A lot of companies, particularly corporate debt, particularly in the United States, companies have taken on a huge amount of debt in the last few years, some of it, to buy back stock, as we know, some of it maybe for some productive investment. A lot of companies, have taken advantage, obviously, of low interest rates to do that, and also issuing long maturity bonds and things like that. Overall, though, the total level of debt in the private sector and leverage loans and things like that is significantly higher. Now, you're, as a former central banker, does the level of debt right now worry you? Should we be concerned about that in the U.S. economy?
So yes, in terms of the business debt and corporate debt, and particularly the lower quality of the debt. So not only is there more debt, but there are fewer covenants around the debt, so that businesses are less constrained about how they can spend their cash flow and more at risk of defaulting if something bad happens. Even in investment grade bond issuance, there's more of it right on the edge of investment grade and below investment grade. So I don't see this level of debt causing a recession. But I do worry that if something bad happens, then businesses will be, if their earnings go down or start making losses, there's an accelerator in there, an amplifier.
Or if interest rates went up sharply.
Interest rates went up sharply
Yeah.
because inflation took off or something, then I think the business debt could easily make the resulting turn down that much worse.
Jack, you're in the private equity business these days, so debt must be a good thing.
Well, I agree with Don 100%. I have to say it was a scary moment to me early on in my days at a private equity firm when partners were saying they were being offered more debt than they thought a deal needed. That didn't seem like a good sign to me. You ought to be sizing it based on the fundamentals, not based on what's available. And I think that we didn't do that, but I think there are investors out there who've loaded up when money was available, cheap with low covenants. I think an aspect of it, apart from the sheer volume, is how closely are we watching where the debt sits and whether or not, if it were to start to become a problem, whether there's contagion risk because of where it sits. I'm not saying there is a problem, but I think the level of scrutiny has gone way down. I don't know that the Financial Stability Oversight Council is putting the effort in that we thought was needed. I don't know if the regulators are asking these questions. And I worry about that because a lot of this debt is repackaged and is showing up in kind of large amounts of informal investment, and some of it could become systemic. It's the kind of thing where, I came in a couple of years into the financial crisis. I think anyone who was there from day one would agree. If you'd seen it coming earlier, it would have been better, and to see it coming later makes it harder. And I'm afraid that we've taken the radar down a little bit.
Yeah, I think
Go ahead.
talk to that point. I think the regulators are beginning to pay attention, but I hope it's not too late. So you didn't mention I'm on a committee at the Bank of England looking at the financial stability of the UK, and we asked our staff, we said to the staff 6 months ago, subprime mortgages, Leverage loans, compare and contrast. Are we at the same risk? The staff came back and said, not really. The amounts outstanding are kind of comparable, but the subprime mortgages were held in highly leveraged portfolios, these structured investment vehicles and things like that, financed with commercial paper. The leverage loans tend to be held in funds or on insurance companies, et cetera. And there's some in banks, but not that much. But I do think that it's past time to be concerned and to make sure that we're not building up the kind of risks that were there before.
So to summarise, you both seem to think the economy is in reasonably good shape. Not going to expect dramatic changes in either direction. We're not lifting the sort of long-run rate of growth. At the same time, you don't see an immediate threat to the expansion. Let's look at some of the risks, though, and some of the things that could go wrong. The thing that's on everybody's mind, and has been literally since day one, since the president took office, is trade and global economic relations more generally. Let me put it, obviously these negotiations with China continue. We still don't know what the outcome's going to be. How much, let me put it this way to you, if I may start with you, Jack. How much of a negative shock do you think it would be to the economy if there is no fundamental deal with China? They came away eventually, the two of them, from wherever they're going to meet, Mar-a-Lago or whatever, and just said, look, we just can't do this deal done, and we go ahead with the imposition of these tariffs by the United States and the retaliatory in particular. How damaging could that be to the economy if there is no deal there?
I think the simple answer is the arithmetic amount of loss to the economy could be contained if there was no spillover. But if there's a full-blown trade war, I think you have to assume there'll be spillovers that are very hard to predict. Disruptions in supply chains, disruptions in long-standing relationships of trust and the ability to do business. And then it spills over into geopolitical risk, which has a life of its own in terms of creating uncertainty. Uncertainty is not a great ingredient in a 10-year-old recovery. I don't think it takes that much additional uncertainty to get a kind of pullback that's far in excess of the direct arithmetic calculation of how many tenths of a % of GDP you lose because of a specific trade conflict. I think the long-term risk to the U.S. economy is quite substantial. I think the kind of go-it-alone approach taken with unilateral tariffs and, frankly, with some of the unilateral sanctions decisions has created kind of blinking yellow lights around the world that is cautioning others from doing business, where after 70 years of being the unquestioned center, there's starting to be a shopping around for alternatives. I don't think anything happens like overnight. It's not as if we're at risk of this flipping in the next year or two, but I think it's a long-term loss of substantial. We get enormous benefit out of being the world's reserve currency and out of being the banking center of the world.
Let me push you a little bit on that, though, so before I come to Don on the trade issue. So the Trump himself will say, and his defenders will say, look, it's all very well. Of course, it's all very well to be concerned about disruptions to global trade, but we have been tolerating in the United States for too long a world in which was unfair, in which we were getting cheated. And I say to you, as Treasury Secretary of the Obama administration for 4 years, that you did see, although you had robust conversations with the Chinese about the kind of many of the issues that the Trump is dealing with. What Trump has been able to do, it seems, in less than 2 years, he's got a revised trade deal with Korea, managed to, in some respects at least, improve the terms of that. He has got a revised NAFTA, a USMCA. We'll see whether it still question marks about its approval in Congress, but he's got a revised NAFTA. He seems to be, if all the evidence is to be believed, about to make some kind of a breakthrough with the Chinese where they will agree some changes. We'll see how enforceable they are, whatever. So the defense of Trump is not that, as he himself says, trade wars are good, but that being tough with these people, being tough with the Mexicans, being tough with the Koreans, being tough with the Chinese, and he says being tough with the Japanese, and the Japanese I think are next in line, it's fair to say, as well as the Europeans, he's going to get better deals for the United States, and the United States is going to end up with a better trading arrangement.
I think there's a difference between being tough and being effective and being tough and being smart. I think we actually were tough. If you look at TPP and then you compare it to the Mexico-Canada agreement, or you compare it to the emerging agreement with China, you'll see a lot of things borrowed from TPP and being relabeled as new policy. Now, I'm not complaining about that. I thought TPP was actually a well-negotiated good deal that got a very bad rap because trade was so politically unpopular and people weren't reading it and weren't reacting to the substance. They were reacting to the idea. So I think what he has successfully done is come out swinging punches so that he can do things and people will call it tough, even if it's in some cases the same thing that was in TPP. I think that is, to say that we weren't aggressive on these issues. You look at what was the major issue on the agenda when I was negotiating with China, it was the exchange rate. For the last 3 years, you haven't heard anyone complaining about the exchange rate. They actually changed their policy, constructive engagement, and pointing out over and over and over again that it was not just destructive to the bilateral relationship, but it was hurting China. We got them to change their policy. Now, I think that was a pretty big deal. You look at the opening of China to banking. The first 3 years of negotiation of that took place under the prior administration. It was sitting on the shelf waiting for an agreement to pop into. I think there was a lot of hard work being done. I don't disagree with you that it was not seen as being as combative and confrontational. But I'd also remind you that we had other things on the agenda with China at the time. China was a full partner in the Paris climate negotiations. Now, this administration walked away from that when they walked away from TPP, I think much to hurting the United States in the process. But we went with China and got both the developed and the developing economies of the world to come together in Paris. The Iran sanctions. In order to get Iran to the table, it required having China and other countries cooperate. We had a complex agenda with China where we made real progress on the unfair trade issues, and we made progress on a lot of other issues. You know, I think if you look at the role the United States has played in the world for the last 70 years, it's a mistake to see it as just that we lost and we got taken advantage of. We can get to more detail on that, but we have to remember the benefit that's come in terms of the economy and security from that.
Let me ask Don, if I may, is Trump's trade approach a dangerously jeopardizing global economic stability, or is it ending up getting better deals for U.S. businesses?
So I think it has the potential for getting better deals in some respects. So I think to the extent that the Chinese were stealing intellectual property, this is inexcusable and shouldn't be tolerated. I do, but it does have Jack talked about the potential for contagion. I can see, if there is no agreement reached, and I can see a couple channels. One is the financial channel. We see the stock market go up and down with every rumor about what's happening to this Chinese trade deal. So if it doesn't happen, and then I think the stock market and financial markets would also react to the potential for the same thing happening with Europe. And so there we're dealing with allies who have been trading with us for a couple generations and who have helped us free up global trade to everybody's benefit. I also worry about the president's focus on bilateral trade deficits. So the fact that we have a trade deficit is a function of what we spend and what we produce. So the U.S. is spending more than it produces, and it's importing the stuff to satisfy that spending that we don't produce here. It's maybe a little bit the function of unfair trading practices, but not really. It's more a fundamental macroeconomic fact. And it shouldn't have been a surprise to the administration or anyone that when we had a fiscal stimulus in 2018 that increased spending relative to production, the trade deficit got bigger. So I do worry that the president doesn't understand the macroeconomics here and that he's focused on bilateral relationships, which is the wrong thing to focus on. And that when he isn't, even if he gets better deals in some sense, better treatment for U.S. businesses in some respects, he's going to be frustrated, and that will spill over in adverse ways to the trading system.
Let's move on quickly, because we'll have time for questions, by the way. Please do prepare your questions. We'll have time for questions at the end. But let's move on to, as we go through these risks. One of the other risks that's been very much on the market's mind over the last 6 months has been monetary policy, subject dear to your heart, Dom. Right. We saw this period at the end of last year where equity markets fell very, very sharply, partly because of China trade fears, but it did also seem partly that there did seem to be a real misalignment between the Fed's intentions, the Fed's monetary policy intentions, and where the market, and certainly where the administration thought policy needed to be and where interest rates needed to be. In the last 3 months, we've seen, I think it's fair to say, a pretty dramatic pivot by the Fed.
Right.
At the end of last year, the Fed was saying several rate increases this year. As of the last meeting, they're saying now maybe no increases this year and maybe one next year. The market and the Fed and the administration, at least to some extent, seem to be much more aligned. Do you think that is? What do you think brought that about? I mean, how did we get into that position where the Fed made this big, dramatic change in its policy outlook and its policy stance over just a 2 or 3 month period?
Well, I think the global economic situation deteriorated pretty quickly in the latter part of last year, and the financial markets went along with them. And maybe the Fed was a little slow to catch up to that. There's a lot of inertia. I can tell you from being inside, there's a lot of inertia in this policy process. It's sometimes hard to pivot quickly. And so they didn't really take on board some of the downside risks and the implications and what the markets were telling them. Now, they shouldn't be just focused on the markets and validate the markets. That would be wrong. They have to make their own independent judgment of where things are going. But I think that took a little while to catch up. Then they pivoted, and I think they're in a good place right now. And it might have been a little messy getting from there to here. But I think a mark, in my mind, of a good policymaker is somebody who says, maybe I wasn't right. Let me get this thing lined up right. And I think that's what Jay Powell and the FOMC
How much pressure do you think Jay Powell and his colleagues feel from the president's constant tweeting and commenting and saying the Fed's got it all wrong, and saying if the Fed hadn't been as aggressive it has been the last year or two, the economy would be growing at 4%. How much pressure, from your perspective, you've been through this inside the Fed for 25 years. What does that do to a Fed chair and to his or her associates when they get that constant political pressure from the president?
So I don't think it affected their policy at all. So I would the most comparable period from when I was inside would have been Bush 41. So George H.W. Bush, fortunately didn't have a tweet. There weren't tweets then, right? But there were press conferences and notes, and there was a Secretary of the Treasury, and
it was very vocal.
And it was pretty uncomfortable.
Yeah.
And I would say Alan Greenspan and the FOMC kept their view on what they needed to do and how they thought best to accomplish it. And I see that's what Jay Powell is doing as well. And I think Powell is doing a very smart thing, which is he's out there explaining to the public. He was on 60 Minutes a couple weeks ago. He's out there reaching out to the legislators, to the congressmen and the senators, trying to build support in the legislature, which is really the ultimate moat against this attack by the
But Jack, if I may ask you, the president does seem to be trying to bring the Fed to heel now, not just with tweeting and statements and speeches, but he's now announced his intention to nominate 2 people to the Federal Reserve Board who are, let's face it, let's set aside their qualifications or whatever for the job, but are robustly, strongly personal supporters of President Trump and his policies. Now, it looks like Herman Cain's nomination is probably going nowhere because a significant number of Republicans have already come out and said they won't support it, but Steve Moore's nomination may fare better. Is this, again, you went through these discussions inside the Obama administration. How much damage does this risk doing to the Fed's credibility and its ability to meet its objectives if this seems to be not just jawboning from the president, but the attempt to reshape the policy-making membership of the Fed in this way?
Obviously, the duration of the appointments has something to do with the ability to do that. I don't see anything changing in the immediate horizon, and I think
That's because there's
there's other members of the board,
governance,
and yeah, I'm sure the meetings will have a different character, as they always do when there are new people in the room. I think that when you look at the environment in which the Fed has been making policy, it is about as hard a decision for the Fed to make as any when it's the time to act in order not to miss the moment, to keep inflation from taking off, and how to hold back and not act in a way which is going to induce a recession. It's a really hard decision. You throw into that hard decision tax cuts and trade policies that are inherently inflationary, and you start getting cross signals in the economic indicators, it's hard to, even when you're data-driven, be able to separate the politics and the data. So I think that the situation went from hard to harder because of the policy, and I give a lot of credit to the Fed for sticking to what's really been an enduring commitment for now 3 chairs, to be data-driven and not to be afraid to either stop or change directions. Everyone should listen to what all of the Fed chairs have said. They haven't said they're going in one way full speed ahead. They've said they're going to look at the data and adjust accordingly. If the data gets more complicated, it makes the job harder.
So you're not too worried about these particular appointments? I'm going to just ask you for the record, you may not want to answer directly, but do you think the Senate should confirm these 2 nominees, if it comes to that?
You know, I can't say that I've looked at the either in terms of minimum qualification, which is what most members of the president's own party will look for. I think the response that we've seen publicly to at least one of them suggests that he's gone outside of the comfort zone of even his own party, and that's a message.
Don, do you think this should be confirmed?
So I worry about public confidence in the institution, and it's partly these 2 appointees that are so openly and vocally political. Any president is going to appoint people who broadly agree with his or her philosophy. That's part of the democratic accountability of the independent Federal Reserve. And every president has done that. Most presidents will generally, Democratic presidents will generally appoint Democrats, and Republican presidents generally appoint Republicans. But 99% of these folks are also experts in economics or banking or finance, and haven't voiced the kinds of views that these 2 have in the past that seem so overtly political rather than rooted in economics, and that worries me about the.
Let me just move on.
I would just add
go quickly, Jack,
that we couldn't even get Republicans through the Senate to get them on the Fed because the Senate just shut down in terms of confirming.
Right. Just very quickly, and again, we're going to come to questions. I have one more very quick question on global risks, which is Brexit. It's on everybody's mind, some minds more than others. Looks like it will be with us forever, like like death and taxes or whatever. But very briefly, and Don, I know you have a particular position on the Bank of England, which makes it very hard for you to comment. But if I can ask you just on the macroeconomic dimensions, if worse were to come to worse, as everybody describes it, there were to be no deal, Britain were to leave and go immediately to WTO terms. Set aside what it might mean for Britain, and I know you don't want to alter the financial system. I don't want to get into that, but just is that something that the rest of the world should be worried about?
Yeah, I think it is, and not only because it might have adverse effects, or likely to have adverse effects on the UK and Europe, but also I think it's a signifier of this broader trend that we've been talking about of economies being less open. Certainly President Trump drawing in and doing the tariffs, but other economies also. So I think there's a lot of evidence that open economies, competitive economies, economies open to trade and to immigration are economies that thrive where productivity and standards of living rise faster than closed economies. And I think that's a significant issue. Now the Brexiteers say they're going to run an open economy, just not so much with Europe,
yeah, exactly.
but it's going to take a long time to transition from WTO to more free trade agreements with a bunch of other
Jack,
folks.
quickly, any thoughts?
Yeah,
on
look,
what
I
you
think that
about-
there's obviously some parallels between the Trump economic agenda and the Brexit efforts in the UK. And I think there's been a rejection by many of globalization, and trade is part of that. And I think part of it is that we've not done a good job making sure that the benefits of macroeconomic growth are broadly shared. To the extent that people feel their job is lost because of an unfair practice, they have every right to be angry. So I understand the anger behind trade. It's a very hard thing to explain that your job was taken over by a computer or a robot. It's a lot easier to say it was unfair practices. And the truth is it was some of both. And we haven't unpacked it. I think the amount that it's technology is greater than we publicly kind of acknowledge in the debate, because it's really hard to know what to do about it, and you can take these kinds of emotional political steps, whether it's a tariff or a Brexit move, to say you're protecting your economy. I think that the underlying threat is not just an economic one, it's a threat to democratic institutions. If working people stop feeling that their government and their economy works for them fairly, it undermines the strength of what's beneath free market capitalism. And we have to worry about that, because it's a system we should all want to protect.
Final question from me, and then I want to come to the floor. And it's a broad one, and I apologise for it in advance, but which is the financial crisis 10 years ago and the Great Recession that followed caused economists to revisit a lot of their fundamental beliefs, assumptions, propositions, challenge the whole notion of macroeconomics as it had been established over the previous 30 years or so. As we 10 years on from that, we seem to be in a strange situation where we're things that we thought we kind of understood about the economy, relationships that we thought we understood, don't seem to be holding, right? You have, the Phillips curve. You have it's always been generally believed since the Phillips curve really came along in the 1960s. We thought there was a pretty sort of rigid relationship between the unemployment rate, so-called non-accelerating inflation rate of unemployment, or the natural rate of unemployment, and inflation. And if unemployment was held below that particular rate for a long time, we would get accelerating inflation. We've now had unemployment at below 4% or below for a long time. There doesn't seem to be any evidence whatsoever of inflation picking up. I want to ask you what's going on there. Secondly, you've also mentioned, both of you mentioned, the tremendous fiscal impulse that we've had. The US economy is now is going to run a deficit this year of about 5%, fiscal deficit about 5% of GDP. One of the concerns people have I've always had about that, is that will lead to it'll force investors to demand higher yields, higher returns. That will push up interest rates. That doesn't, and now we're still bobbling around with 10-year interest rates below 2.5%. So we've had a massive fiscal expansion, a massive expansion of the debt, and it doesn't seem to have been reflected in interest rates. And that leads, by the way, onto this whole question that some people have raised about modern monetary theory, which many of you will be familiar with, which is, do we need to worry any more about deficits? What's going on, Don? Are these relationships breaking down, or is it just taking time until these historic economic relationships reassert themselves?
Well, I think there are a lot of new relationships going on here, and the inflation Phillips curve one is one of them. So I would have anticipated somewhat higher inflation, not hugely higher inflation, at this sort of unemployment rate. If you'd asked me 2 or 3 years ago, I would have at least thought that inflation would be creeping up. So what's happening? Truthfully, I'm not sure. But I think there are a couple of factors here. Part of it might be the globalization, and to the extent that we draw borders and walls around our economy, the effect of globalization keeping down inflation is going to erode. Some of it may be technology. It could be that, as Jack was alluding to, new technology replacing maybe some of the more expensive jobs, et cetera, is helping keep inflation and costs down. And the third factor is inflation expectations being very firmly anchored around 2%, around the Fed's target. And I think that gives a huge amount of inertia to the inflation process. And what the Fed is worried about, actually, is that those inflation expectations might start to slip. You should pardon the expression, the Japanification of monetary policy. That is, Japan, as you folks know, has been locked in a very, very low and zero, essentially real price stability or even deflation for a decade or more now. Inflation expectations are down there. The Bank of Japan and the government wants to bring inflation up towards 2%, like many other countries, and they found it impossible to do that. So I think one of the things that I'm sure that one of the things that has the Fed's attention and got the Fed's attention late last year and early this year when it turned to pivoted, as you noted, was the fact that inflation hasn't picked up the way it thought, and there are some signs in some of those measures that inflation expectations might be coming down, and that's a good reason to keep your foot on the accelerator for a while and make sure you don't get caught in that low inflation.
Jack, let me ask you on the fiscal side. A lot of your fellow Democrats, many of whom are running for all of whom are running for president.
Seems that way these days.
Many of whom are running for president.
You're throwing your hat in the ring, Jack.
Are espousing this new approach to fiscal policy, which says, it doesn't really matter what deficits are. If you listen to Elizabeth Warren or Alexandria Ocasio-Cortez, she's actually not running for president, but only I think because she's legally disbarred because of her age. But there does seem to be a changed view in the Democratic Party, both in terms of a significant move towards the left on some of the big issues like taxes and regulation and whatever, but also on this issue of fiscal policy. And look, we can expand the deficit significantly. It's not going to have any effect. That wasn't your message very much when you were Treasury Secretary. You were very cautious about the deficit. Did you get that wrong, or are they now getting it wrong?
First, I think that it's not as if there's just one view. People should remember that when the House flipped from Republican to Democratic control, one of the rules that changed is that the pay-as-you-go rule was put back in place, so that if you want to have a tax cut or you want to spend money on an entitlement program, you have to pay for it under the House rules now. That's not universally popular because there's this counter theory that this concern for deficits has been exaggerated and should be set aside. I think it's a mistake myself to think that you can continue growing the debt forever and never have any consequences. First of all, comparisons to Japan just don't make sense because Japan's debt is mostly domestically held. Ours is about 50% internationally held. So every dollar we pay to service our debt is a dollar that goes out of the United States. That's, I think, a big part of the reason why Japan could get to 200% of GDP debt and not have the kinds of stress on its domestic economy that we would feel if we hit a similar measure. Secondly, the low interest rate environment may mean that when interest rates go up, they don't go up to 10% or 8% or 7%. But as they creep up from the 2s into the 3s, into the 4s, we've seen this pendulum of concern swing. And I think the pendulum will swing back to being concerned about what are we doing to the next generation? Are we mortgaging the future in a way we can't pay for? As somebody who's proud to be a progressive Democrat, so I'm taking a view that's opposed by many, I'm very concerned that when that pendulum swings, the thing that's put in jeopardy are some of the most important things we do in our society, from investments in education and research and development to making sure we have a social safety net that a compassionate, rich country should have. Now, I don't think those issues are being debated that way. It's being offered as a free lunch. As a free lunch, if you don't think about the economics, it's pretty attractive. There's also a bit of a get even. I can say personally, I've twice had the experience, the good fortune, to take a deep deficit and turn it in one case into surplus for 3 years, in the other case to reduce the deficit from 10 to 3% of GDP. So one could say you ate your spinach, you handed things off in good shape, and both times the first thing to happen is a huge tax cut that put us right back where we started. So right now there's a certain amount of get even. My own view is some of the hole for the tax cut should be filled. And then as concerns about the deficit start to grow, you need to have a bipartisan discussion. There's a lot of things I would do to raise revenue. I think it's a terrible thing in a country where one of our biggest problems is income inequality, that we've made it possible to transfer huge amounts of gains of capital wealth with no taxation ever. Okay, we ought to close that.
Let's wrap it there. Good. We've got plenty of time for questions. Gentleman in the front, if you could identify yourself, please, as well, and there's a microphone coming your way.
Thank you. I'm Jeremiah Johnson, Policy Director at the Neoliberal Project. My question is for Mr. Kohn. I'm really glad that Mr. Baker asked about the breakdown of these kind of statistical relationships, because it may not have been easy to do monetary policy in the 80s and 90s, but it may have been a little simpler when there was a direct relationship usually between inflation and unemployment. So my question is, with the breakdown of that relationship, very low unemployment for years now without significant inflation, is the Fed now looking at the wrong metrics, or should they be looking at different metrics to measure a different target? Is there a mismatch between what they're targeting and the type of things that they should be looking at?
Well, they are tasked by Congress with targeting two things: stable prices and maximum employment. Now, that is more difficult when you don't understand fully the quantification of the relationship of those two things. I agree, and that was Jerry's point. But I don't think that relationship is entirely broken. Maybe, I took my principles of economics 50-something years ago, to tell the truth. Now, I don't want to think about how many, but, and we learned about supply and demand, and I really have trouble
Samuelson, not even Samuelson's first edition.
No, well, it was Samuelson's third or fourth edition, I think. But, so I think the basic relationships are still there, even if we don't fully understand them. But I think the Fed's done a really good job of keeping their eye on those two things. And as long as inflation hasn't been picking up, they're willing to let the economy run, keep rates low. Even with the increase in rates we've seen, they're still extraordinarily low, barely positive in real terms. So they've been willing to let the economy run and the jobs market run. So I think that just focusing on those two goals has been helpful to them. I don't think there are any new metrics that you need to look at.
Thank you. Yes, gentleman over there.
Oscar Fortunato, the Eurasia Center. Mr. Secretary, you mentioned policy working in the wrong direction. In your opinion, have there been materialized reductions in the U.S. ability to offer security assurances to countries like Japan and Korea? And what could be the consequences to the U.S. economic relationship with these countries if a material reduction has indeed occurred? And a follow-up question to Mr. Baker. The Secretary mentioned people reacting to the idea instead of substance. As you know, misinformation campaigns have been directed towards the political realm of things. What can you do as a journalist who works for the Wall Street Journal and used to work for the BBC to try and mitigate when misinformation campaigns tries to influence the markets? Thank you.
I'll let Jack answer.
So on the alliance
I'll
question,
the second one.
I don't think anything's changed our capacity to be a strong alliance partner. It's a question of whether our alliance partners can count on that being the policy and desire of the United States. I think our alliance partners very much want the United States to continue to be an anchor in the Pacific, in Europe, that can create a stable security environment that has been, I think, the thing that's kept the world more peaceful and more prosperous for the last 70 years. I think they're asking the question now whether that's a role the United States wants to play. I actually think you're seeing a fair amount of pushback to suggestions in the here in the United States that we should walk away from it. I don't think it's broadly popular when the administration raises questions about the value of NATO or the value of the Pacific Alliance. I worry that if it becomes just an article of constant concern that you can't count on the United States being there, that other countries start to make decisions to either do more self-defense or to diversify their relationships of alliance protection. That wouldn't be a good thing. So I think it's very important that we double down on a structure. It doesn't mean it shouldn't be modernized. It doesn't mean that we shouldn't do more burden sharing. But it is not a mercenary arrangement that we have NATO in Europe. We have NATO in Europe because after 2 world wars, it was a way to make sure we didn't have a third ever again. And that protects the United States, and we get great value out of that. And I think it's at our peril if we don't treat that as something that ought to have many more generations.
I'll very quickly answer your question because I do obviously want to hear from the economics experts. But just I may be missing something here, and it wouldn't be the first time. I've missed many things in my life. I don't get all that panicked about this concern about false information and fake news. Not because one should be concerned, one shouldn't be concerned about. One should, but it's been around a long time. I always like to quote. I work for the Wall Street Journal. The Wall Street Journal was founded 130 years ago. And on the front page of that very first, in fact, it was only one page when it was first published back in the 1880s. There was a statement from the founders, Charles Dow and Edward Jones, Mr. Dow and Mr. Jones, who said the reason they were founding this newspaper in the 1880s was because there was a huge amount of false information, gossip, rumor, error, malicious, deliberate misdirection out there. And there was a demand in the market, it was felt, for accurate, reliable information that would provide people with the facts that they needed to make important business and investment decisions. That was 130 years ago, and that's why the journal was founded. And I think, obviously, the ways of disseminating false information are now have multiplied enormously, and we have social media and the web and all that kind of stuff. But it's always been out there, and I think as long as news organizations stick to going about doing what they've done, the best news organizations, and I've been lucky enough to work for many of the best news organizations in the world, go about what they do in a thorough and rigorous way, that will be, I know there's a fear that it's all going to be overtaken by all this fake news and all this false information that's out there. I think people will come to understand that there are trustworthy news organizations that people can actually rely on. And if the worst thing we could possibly do is to sort of somehow try and either go after those false information, those false stories, or somewhere try to undermine them, or somehow get into the ring with them and try and fight with them. I just think we just need, again, maybe I'm missing it, but I think if we just stick to what we do, and the history of the last few years for me has been instructive. The Wall Street Journal, and I'd say this not as a piece of advertising, but the Journal, all of the evidence is that the Journal continues to be the most trusted news organization in America, especially among people who need to make business decisions, who need news to make business decisions. We have tons of survey data, literally comes out week by week, month by month. People trust the Journal, and that's because we just stick to doing it in a rather unspectacular, I must say, a rather undramatic, non-melodramatic way, just sticking to doing the reporting, because in the end, I do believe that's what people are able to discern between the truth and falsehood. Yes, gentlemen, there we go. A lot of questions.
Hi, Steve Cardman, Cardman Associates. My question concerns the international realm. It's been almost 10 years since the onset of the Eurozone financial crisis, debt crisis. I'm wondering if you see any lessons that have been learned from that, particularly as to the austerity versus growth debate that was very much central to that whole experience, and how we should manage future crises like that.
Okay.
I wish I had $1 for every meeting of international bodies where I had to debate austerity versus growth. During the years after the financial crisis, the countries that worked quickly to stabilize their banking systems did better than the countries that took a longer time. And then in Europe in particular, the rules changed and it became harder for the actions to be taken. So, kind of getting back to the idea that we were discussing earlier, acting quickly, acting decisively may be unpopular, but it's the way to get an economy to turn around. Dealing with austerity is, I think, more of a political than an economic decision. In Europe, in order to get consensus in the Eurogroup and amongst the countries of Europe, there was a necessity to balance packages that were perhaps more draconian more quickly than was consistent with a smooth return to a healthy economy. I think if you look at some of those economies, some have done better than others, but they're mostly coming back. Even Greece is coming back, where unemployment is still way too high, but it's not at the staggering 25, 30% level. It's in the low teens, and it's going to the bond market again. Would Greece have recovered more quickly if there had been less austerity up front? Yes, I think it would have, because macroeconomics works that way. Could there have been the agreement within Europe to take the fairly controversial steps over and over again to stand by Greece? Probably not without it. So I don't know that you got to choose. I mean, even though I took the growth side of the austerity growth debate, no agreement in Europe would have been a disaster. And coming to the end of the 10-year period, I'm glad that we were able not to have austerity versus growth stand in the way of making the kinds of decisions that got countries like Greece and Portugal and Spain back on their feet.
To some extent, I think it's a bit of a false dichotomy, because once markets lose confidence, investors lose confidence in the debt issued by a particular country, then issuing more debt isn't going to work. So you've got to move in that direction to set the stage for the recovery. I think all in taking the Eurozone as a whole, there could have been less austerity and more growth, particularly coming from Germany, the surplus country that would have driven growth better in the other countries. But for a country like Greece or Portugal or Spain or Ireland, I think they needed to get, particularly Greece, needed to get that budget under control before they could return to the financial markets.
Right, more questions. We've got a few more minutes. I do want to try and get in as many as possible. There's a lady here at the front.
Thank you. Yu Miao from the Chinese Consulate General in New York. So I have two questions. The first is, looking back for the 10 years, what do you think is the fundamental reason that the US economy is among the first to pick up? There are certainly stimulus policies offered by the central banks, but other countries have done that. But why US is the only country that picks up so fast and extends this expansion for so long a period? So what's the fundamental questions in your opinion? And the second is, it's a little broad, but just really curious to know, what do you think of the stock market so far? Well, we know the S&P companies, their revenue and earnings are facing a dramatic decrease compared with that in 2018. But yet we still see a very robust stock market entering this year. So what is your expectation, midterm expectation?
Don, are you a buyer or a seller? No. No, go on.
I hold a diversified portfolio, Jerry, so I don't have to worry about it. I'm not going to answer the second question. I have no idea. But on the first question, I think your question is interesting, because Jerry earlier said, why was the recovery so slow? Right?
But that was, in historical terms, I mean, the point is fair that it
the
was
US,
faster than
the
Europe.
US was ahead of others, and I think it was because we took prompt policy action. TARP, getting the money into the banks to stabilize, and the stress test to show they were stable, and forcing the banks to raise capital early. Poorly capitalized banks won't make loans, so you got to get the capital into them. The Obama fiscal policy, which put big stimulus into the economy coming out, and I have to take a little bit of credit for the Federal Reserve. I think we innovated in many respects in keeping interest rates low and telling people they would be low, and then doing QE, buying securities. So I think early in our expansion, all those factors helped to push the economy up, and we did it fast.
Yeah, I agree with Don. I would just summarize it by saying we used all three policy tools. We used fiscal policy, monetary policy, and the structural reform to fix our banking system in a time frame where the things were complementary to one another. In other countries, one was done, then another, then you didn't get the benefit of them coming together. I wish we hadn't lost the zeal to keep all of the policy tools going, because we probably could have done better in 2011, 12. But getting from 8 to 11 the way we did, I think, was a difference that made a difference.
Thanks. If we're quick, we've got time for a couple more questions. Gentleman at the front had his hand up here.
Hi, Peter Burgess, True Value Metrics. I'm always interested in these conversations about the role of the household balance sheet. I would argue that over the last 40 years, the American household balance sheet has been completely gutted. The financialization of the economy has done very, very well. But, ordinary people have basically been screwed, and it's not good enough. And I would just like to have your views on how much that contributed, first of all, to the financial crisis, and secondly, is it going to have the same sort of impact on where we are at this time? I mean, student debt, the automobile industry, car loans underwater mainly. I'm curious.
Well, student debt's going to be a federal problem rather
Yeah, I was going to say student loan
household problem. But anyway,
student loans is a budget issue because they're all guaranteed by the federal government, so it's not a financial stability issue. In the early years of the financial recovery, we looked at the deleveraging of the American household as a good thing because it was putting strength back in the balance sheet. But you look at how that happened, it happened by foreclosures. And that's a bad thing. I think the issue is more of a political than an economic one in the sense that there is this perceived lingering sense of unfairness that TARP bailed out the banks and families were left with their defaults on their homes. And on the one hand, TARP was fully repaid, so you can say taxpayers were held harmless. On the other hand, banks are doing well, and there's a lot of households that feel left behind. I think that helps explain some of the populism of the right and left in our country. As an economic matter, it wouldn't have been necessarily better not to have that correction. As a political matter, it's a big problem.
John, to the gentleman's point, I mean, I think the numbers, you know the numbers better than I, but I think household net worth is actually reasonably healthy right now. But the distribution is very skewed. Right?
So the real issue, perhaps, and Jack talked about this a little bit earlier, is the folks getting left behind. Right. So yes, households are actually, debt has been paid down relative to income. We didn't talk about household debt as a financial stability issue because it's not. It's business debt that's the financial stability issue. So I think sort of on average, households are fine, but there are so many of them have gotten left behind. That's the real problem, the inequality and the lack of progress at the middle and lower incomes that the country needs to come to deal with.
We have time for one more question. I'm going to try and capture anyone who's had their hand up for a while. Well, there's a gentleman at the back who I haven't. There we go, over there. Sorry for everybody else. But,
Hi, I'm Connor Brophy from Sumitomo. You expressed some concern in the leveraged lending market. Just was curious if there's ever been discussion in DC about requiring institutional term loans to become SEC registered securities to, just get some more insight into their primary issuance and secondary trading. And how would you suggest that market receive better oversight generally?
We put a fair amount of effort in general into trying to look at were there risks in shadow banking that needed to have more visibility or regulatory response. At the time, we were more worried about things in the hedge fund space, particularly automated trading. I don't know if those questions are being asked today. I suspect that there is a lower level of inquiry now than there was. It was not taken well by the asset management business. We asked the question, and from the amount of lobbying against the effort, you would think action had been taken. All we did was put the radar up to say we want to know if there's something here that we should pay attention to. And I really worry that that question is not being asked now.
all right, since that was a very short and technical question, I think we do still actually have time for one more question. So, gentlemen here, you had your hand up for a while here. Very, very final question. No, sorry, this is your here. You had up for a while.
I wanted to ask you a question. Alton Ergun from ECM Portfolio Manager. If we go to a recession, assuming in the recession scenario, what are the limitations on the fiscal side? What are the limitations on the monetary side, assuming the interest rates has not been raised too much? What next stage QE is possible? Do you see hard assets being bought? And if you go to negative rates on the QE, what does that mean for the business and the society?
Yeah, so I think it's a real concern that if the economy turns down, we already talked about one possible amplifier, business credit, and that would imply that any turn down would be maybe a little worse, that there is limited policy space. So on the fiscal side, because debt is growing so rapidly and deficits are already so high, there's going to be a great reluctance to engage in the kind of fiscal counter-cyclical policy that will be necessary at the time. On the monetary side, there is only a limited amount of ease there. I don't see, first of all, in terms of what assets they could buy, they're limited under the Federal Reserve Act to buying assets that are issued or guaranteed by the U.S. government or one of its agencies, so there's no possibility of going in and buying corporate bonds or equity or anything like that. So I think that QE would be activated at some point if the recession got too bad. And on negative interest rates, I think that's something the Fed is taking a look at, and they said they're taking a look at. I think the Fed is to be applauded by running now a public process to look at whether their 2% inflation target is structured correctly, the instruments that they're using to hit that, what the risks are, do they need to change things? So they're going out and asking people and having a public conference in early June about this. So they're posing the same questions that you just posed, and it'll be interesting to see the answers.
We have covered a lot of ground there in 75 minutes. Please join me in thanking our two terrific speakers, John Kohn and Jacob Lew.
Great to see you.